Welcome to my channel. I'm Scott, and I'm going to walk you through the process of valuing Meta's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Meta is the parent of Facebook, Instagram, WhatsApp, and many more brands. It is considered one of the world's most valuable companies. Most of the revenue generated is from the sale of advertisement space on its various platforms. It has a mind-boggling 3.7 billion monthly active users across all its platforms. That's almost half the world. Facebook alone has 3 billion monthly active users. The company is headquartered in Menlo Park, California, and was founded in 2004. The ticker trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, Euronext Paris, Zitra, Vienna, Swiss, Santiago, Kazakhstan, Sao Paulo, Italian Bourse, Lima, Buenos Aires, Bulgaria, Ukraine, and London Stock Exchange. Let's get started with the model. This is a large cap company, 530 billion market cap. They're trading at $205 a share, and they have 2.6 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So the company is a cash cow, literally. They went from 21 billion of free cash flow way up to 39 billion. It did drop a lot in 2022 due to the large investments into the metaverse. But it's still 19 billion of free cash flow. That's the cash that's remaining for you, the investor. So they don't pay a dividend, but they do buy back a lot of stock. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that doubled from 18 billion to 39 billion, then dropped a lot in 2022 to 23 billion. Revenue is the sales for the company. That peaked in 2021 at a mind-boggling 117 billion. It did drop a little to 116 billion in 2022. This is the company's income statement. The top line is the revenue, the sales. Their revenue in 2022 is 117 billion. Let's dig into that number so we know what it is. Of the 117 billion of revenue, 114 billion was from advertising on Instagram, Facebook, WhatsApp, and Messenger. They did generate 2.2 billion of revenue from Reality Labs. That is down from 2021. That's revenue from the metaverse. That's a sale of hardware products, content, and software. So that's really been a big flop for the company, the metaverse. But things may change. Who knows what the future is going to hold. Their revenue in US and Canada is at 50 billion, down a little bit from 2021. Europe is 27 billion, down from 2021. Asia Pacific is up a little bit. They're at 28 billion. And the rest of the world is up. That went from 10.5 billion to 12 billion. Let's go back to the company's income statement. Below revenue is cost of revenue. These are all the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and they have amazing margins. 91 billion of gross profit in 2022, down from 2021, but up a lot from 2019 and 2020. Then you have operating expenses. These are all the expenses not directly related to generating the revenue, such as marketing. Gross profit minus operating expenses gives you your operating income, which is down a lot from 2021, up a little from 2019. Then below that is their interest income, 276 million. They don't have any debt, so they don't pay interest on their debt. Or at least they don't have any interest-bearing debt. I think they have a little debt, not too much. They were debt-free for the longest time. I think they've added debt recently. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. When it's a big negative, it's usually an asset impairment. That's when you decrease the value of an asset on your balance sheet and pass through the loss onto your income statement. Then your pre-tax income, your taxes, and the bottom line of the income statement is your net income. 23 billion, which is a big number, but down a lot from 2021 of 39 billion. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. They generate an amazing amount of cash flow, 50 billion in 2022. It is down from 2021 of 58 billion, but up a lot from 2019 and 2020. Then you have CapEx. You can see that CapEx is up a lot from the metaverse, 31 billion in 2022. It was half that in 2019 and 2020. Operating cash flow minus capex gives you your free cash flow. Most of their free cash flow goes back to you, the investor. They buy back a lot of stock. 28 billion in 2022, 44 billion, 6 billion, 4 billion. When a company buys back its own common stock, that decreases the shares outstanding and makes your shares more valuable. They did add 9.9 billion of debt in 2022. They didn't add any debt in 2019, 2020, and 2021. Let's look at the capital structure. 126 billion of equity, 27 billion of debt. They're 83% equity, 17% debt. And they could pay off all the debt with the cash on their balance sheet and still have 14 billion of cash left over. And I gave them the lowest whack on Finbox, 9.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year for that 600 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $527 billion. We divide that by 2.6 billion shares. And we get a calculated stock price of 203. They're trading at 205, so they're trading at a 1% premium. It's a sell according to the model. The company's revenue forecast for 2025 is 150 billion. For 2024, it's 136 billion. For 2023, it's 122 billion. I continue this trend into 2026 and I got 164 billion. That's how I got their future revenue estimates. They convert on average 26% of their revenue into free cash flow, so I multiplied their future revenue estimates by 26%. That's how I got their future free cash flows. I did give them a little haircut in 2023. I reduced their future free cash flows even more. That's why it's only 22 billion. The website Simply Wall Street values the company at 242. They're saying it's 15% undervalued. 45 analysts priced this stock and the average price target is 230. The low is 110, the high is 307. That's quite a spread. Another 51 analysts priced this stock and the average price target is 223. They're saying the stock is 9% undervalued. This is where the stock has been trading the last 5 years. It did get up to about 380 a share and then took a huge dive. I know some people commented on my videos that they bought the stock when it hit 100 or even a little below 100. I'm sure they're really happy now it's over 200. And I've heard people say this stock is done, the company may go bankrupt, but I really don't think so. I think they have too big of a market share and they are a smart company, even if they made bad decisions. They bought Instagram, which is considered the best acquisition ever. Even Warren Buffett doesn't pick all winners. We all make mistakes. This is just another blip in the road. Lots of stocks have crashed the past year and a half. This has rebounded nicely. Hopefully it gets back up to where it should be in the 300s and 400s. But the company is struggling a little bit to get their credibility back. But that's inside the US. Outside the US, they're still really, really popular. In the past 5 years, this stock is only up 29%, while the S&P 500 is up 53%. At one point, you would have been up 150% of this stock, and then you would have been down about 35%. So it is much more volatile than the S&P 500. This is one of my better investments. When the company IPO'd in 2012, I bought the stock at 40 a share. I did make a pretty good return on the stock. I did some options trading on it, and I bought back in again, I think around 2018. So I'm up about 20-30% on that. But I bought more in 2021. I'm down about 25% on that. But overall, what I'm currently holding, I'm up on, plus what I sold in the past on Facebook, I made a good return. So I'm pretty happy with this company's performance. They have a beta of 1.18, so the stock is a little more volatile than the market. In the past 52 weeks, it's down 12%, while the S&P 500 is down 14%. The 52-week low got down to 88. The high was 237. And the stock is trading well above its 200-day and 50-day moving average. This is still a really popular stock. Well over 30 million shares are traded each day. Almost all the shares outstanding are on float. 76% are held by institutions, and only 1% of the shares are shorted. If you were like me, you put $10,000 into this company when they IPO'd, you'd be at $78,000 today. But at one point, you would have been at about $130,000. That's a 25% annual return, a 670% total return. The CEO's annual salary is $1, and the total compensation package is $27 million. In the past 12 months, there's been only insider selling, no buying. That's not a good sign. And everybody sold below $200. If they would have held on, they would have done better. 64% of the companies held by institutions, 22% by the general public, 14% by insiders, and a small percentage by the government and private companies. Even though the company has done some recent layoffs, they still employ lots of people and it grows each year. Look at the growth year after year. They almost hit 90,000 employees. They're currently at 86,500. The great Mark Zuckerberg is the biggest shareholder at 13%. He's worth $71 billion. The next biggest is Vanguard, BlackRock, Fidelity, and Capital Research. The best way to look at ratios is to compare them to companies in the same industry. There are 62 companies in the same industry as Meta, and if Meta has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they rank second in market cap, second only to Google, and after them, it's a big drop-off. Ironically, they spend almost exactly what Google spends in CapEx. They have a really low debt-to-equity ratio. For every dollar of equity, they have 20 cents of debt. They generate a ton of free cash flow. Google, of course, has a lot more. They have a big market cap, but they were getting close to $1 trillion at one point. Now they're at $530 billion. Their price to book is worse than average, PE almost exactly average. Price to free cash flow is worse than average, so they generate less free cash flow as a percent of their market cap when you compare it to the average in the industry. Their price to sales is lower than average. They generate a ton of revenue. They're still growing. Their 5-year annual revenue growth rate is 23%, although in the last year they're flat. And they have a really high ROA, that's net income over assets, and a high ROE, that's net income over equity. So to summarize, I have them trading at a 1% premium, and I think this is a great long-term hold. If the company does go down, I'm going down with the ship because I plan to hold this stock into retirement. I have a lot of faith in the company. I rank their free cash flows, revenue, and ratio as 6 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.